let's talk about, can you trade with Fibonacci retracements alone? All right. The concept of Fibonacci retracements, right? A lot of people are asking me, what is the main way you trade, right? What is your main trading strategy, right? And I can confidently tell you that 80% or 90% of my trading strategy revolves around Fibonacci retracements and Fibonacci extensions, right? Can you trade with Fibonacci retracements alone? Yes, but to trade it effectively, you need Fibonacci confluence, right? And confluence is where multiple things line up, add up together. Just let me see if I have the slide over here. No, I'll be showing you guys the slide later, right? But the concept behind Fibonacci confluence is when multiple levels line up together, and that increases your probability of a trade working. All right, and I'll be showing you how, we look at the markets later, how to filter the good from the bad and how to trade it. Okay, now what are the long answer to a short question: yes, you can trade with Fibonacci retracements alone, right? But for it, you don't just use a single Fibonacci retracement number. You need to find multiple Fibonacci retracement numbers, right, before you can find a high probability setup. Okay, so what are the important Fibonacci ratios, right? Let's see if I have it here. Yeah, there you go. Okay, these are the important Fibonacci ratios. Okay, I am not highlighting a single one. A lot of people like to say 61.8 is the golden ratio, right? And you're not wrong that 61.8 is a golden ratio, but if you just trade purely on 61.8 retracement alone, you're not going to make money, right? It's not going to be effective, right? Instead, what you need to do is to once again Fibonacci confluence, right? I know it's a little bit confusing that you're looking at this and like, why do you split it into three? Why do you have like the negative, and then you have those from 0 to 100, and then you have those above 100? Like, what the heck does that mean, right? So I'll be showing you a little bit more about the traditionally, most people just stick to this Fibonacci retracements. They stick to those within the 0 to 100. What I can actually tell you is that what is really effective is this area, the negative, and those that are above 100%. Those are really strong retracement levels, but you need to know how to use it correctly, right? And I'll be showing you how to use it correctly later, and it'll open your mind, right? Open your mind to a whole new dimension of using Fibonacci retracements. Very powerful, and yeah, and we will touch on that in probably I think 2 chapters from now. All right. Now I'm moving quite fast, right? So once again, guys, if you have questions, please ask them. Right? There's a place for there's this thing, go to webinar, where you can ask questions straight away. Once again, I literally have another monitor open right here, right? Monitoring your questions. So if you have a question, ask it straight away, because I cannot guarantee that at the end of the session, I will have the time to explain to you or have time to address these questions. So if you have questions, just ask it straight away. All right. So now, understanding the Fibonacci retracement. The first thing you need to know about Fibonacci retracement is that it works well when there's a clear market structure. And in what you're seeing over here is what I call an unclear market structure. All right. Let me see if I can use my pen. Once again, I know you guys hate it when I draw, but too bad, right? I love to draw. So you can see there's a very unclear market structure, right? The price is going down, up, down. This is what I call this is hell for Fibonacci. Okay, because Fibonacci works very well when you're looking at the clear structures, right? But when you have it like this, it becomes very ineffective, right? And I'll be showing you. Okay, you know what? I'm just going to show it to you right now. What I mean by this. All right, so how clear Fibonacci structure works is that, when you're looking at Fibonacci over here, you want to look for the clear market structures. I'm looking at it here, and this is the market structure I see, right? This is a very clear movement down. This is a very clear movement up, down, up, down, up, down. These are clear market structures, okay? So when you're drawing a Fibonacci retracement, what you will notice, and you got to see my mouse, right? I click on it and I go all the way down, right? I'm not sure you can see it, but can you see? Can you see that I have a dotted line over here, right? I have a dotted line. And that dotted line is what you call your Fibonacci trend line, right? And it's supposed to be price needs to follow this trend line very closely for it to be accurate. What do I mean by that? Is that in this example, right, price follows the trend line very closely, and hence the retracement is good. It is effective, right? However, if price, if you draw a Fibonacci retracement, someone say draw it from a high to a low, right? You draw it from here all the way to here. Now, what is wrong with this Fibonacci retracement? You see that initially it looks like price is kind of moving quite closely with it. Then out of nowhere, right, there's this massive spike, right? And you see the distance, well, the distance of price over here from your trend line, right? The distance is so huge. And because of this, your Fibonacci retracement will not be effective, right? Whether it's your retracement or whether it's your extension, right? What you want to do is to always draw it very closely. Draw it very closely to your to price. The closer it is to price, the better you obey the structure of the market, the more effective your Fibonacci retracement is. All right. So anyway, trying not to deviate too much, right? This is what I call as unclear market structure, right? And this is what I mean by clear market structure. So you can see like what I drew earlier. The way the market moves is just it's very clean, right? You get very strong little zigzags here and there, right? And one of the tricks to get this is if you're looking at a market like this and you're usually on the lower time frames, maybe like the 5-minute charts. I don't know. Oh, sorry. I guess the 5-minute charts, it might look very messy, right? It might look very messy. But if it looks messy on a 5-minute chart, right, what I tend to do is I tend to take a step back, zoom out a bit, and you get to see a clearer market structure. So on the 5-minute charts, it wasn't clear, but on the 30 minutes, you're seeing much more structure, right? So usually in these kind of cases, right, what can really help, right? If I can find an example over here, let me see, I can find, yeah, Euro Sing, not Euro Sing still okay. Euro Aussie, yep, you see Euro Aussie here is just very, very messy. What I don't like to see is I don't like to see the big wicks. Why do I hate to see big wicks? Okay, it's very simple. When it comes to Fibonacci retracement, what you're usually doing is you're taking, from a high to a low, right? You're taking something from like, the right at the high over here, all the way to the low, right? This for as an example. So your wicks are very important, right? Your wicks are very important. If you're weak, right? If you're, for example, right, when I see this kind of market structure it is usually on those less liquid currency pairs, right? The crosses, mainly the crosses, the minors, right? You won't see this on something like euro dollar. You won't see this kind of, sorry, you won't see this kind of big like little wicks here and everywhere, literally every single place you're seeing this kind of big wicks, right? The problem with these wicks is that when it comes to Fibonacci retracement, right, if your wick is just a little bit longer, and that's the thing that happens with crosses, or yeah, with what the heck is that word, crosses currency pairs, right? Rather is, yeah, your minor currency pairs, is that, see, in one situation my Fibonacci retracement is here, and in another situation, yeah, the Fibonacci retracement is slightly lower, and this affects, can you see, this affects the accuracy of your Fibonacci. So usually Fibonacci works better, I personally feel, on the higher time frames, right? 30 minutes and 1 hour and beyond, right? If the market is less choppy, right, and not so much on the exotic currencies, right, where it is debatable where is your ending point or starting point of your Fibonacci. Right, Rich, I can see that you're asking a question. Yeah, I can see your question. So don't worry. If you have questions, just shoot them straight ahead. I see that. Okay. I mentioned about price moving. All right. Okay. Yes, I'm glad that my explanation of how price needs to follow your Fibonacci so-called trend line very well, right, has helped you. Tafatswa. Hey, nice to see you again. Anyway, right, back to my topic. CAD yen, right? We're looking at CAD yen. We're looking at this. We're looking at clear market structure. So sometimes, like you look at CAD yen, there's less of that crazy kind of wicks that you see, and that is because CAD yen, naturally, the yen currency pairs tend to be less, tend to fluctuate less, right? Because it's hard to give a reason, right? But you'll notice that it tends to fluctuate. It doesn't tend to be as wild as something like Euro Aussie, where literally, every single corner, every single turn is a big wick that you see. All right. So once again, don't want to digress too much, but some things you need to take away from this is that if it looks too messy on the lower time frame, try to increase your time frame, right? Try to look for try to go for higher time frames, 1 hour, 4 hour, to better see the structure of the market, right? And yeah, usually for the higher time frames, it starts to be okay to look at different currency pairs, the majors, the minors, right? What you probably want to stay away from are stuff like, on Euro Aussie, if you look on something like dollar ringgit, right? I guess yeah, that's terrible. Maybe dollar CNH. Dollar CNH is actually pretty okay, right? But so what I'm very afraid of are stuff like this, right? Like this spike down here, right? I'm always very worried when I see a big spike, right? Because spikes basically mean that it's different brokers, different price feed, right? One, the for this case, this broker's price feed might be over here. The spike might end over here. Another spike might end a little bit higher. Another spike might end a little bit lower, right? And all of that affects the accuracy of your Fibonacci retracement, right? So every time you see something like this, a big spike, right, always be careful, right? Especially the spikes are very, very big, right? You in this case, right, I like this, right? Very small spike on top, very small spike below, right? You can see how price tend to obey, touch 23, touch 38, touch 50, it obeys it slightly better, right? You need clear market structure, you need less room for ambiguity, okay? Now, all these important things to take note of, right? I'm not even halfway through and we're almost halfway through the webinar. So we have a question from Imad. Nice to see you again, Imad, right? Does Fibonacci retracement work best in trending and ranging markets, but not choppy markets, right? They work in both, right? And that's the beauty of Fibonacci. They work very well in trending, they work very well in ranging, but they work very well in choppy markets. Rather, the key thing you need to look out for, sorry, the key thing you need to look out for is clear market structure. So your determining factor is whether there is clear market structure, right? I don't care if the market is like this and it's going up and down, up and down, up and down, right? There's a range, it's a trend. Some people call it choppy when it's going up and down. It's not deciding which direction it's going, right? Rather, what you're looking for is you're looking for that clear market structure. And what brings about that clear market structure is really liquidity, less noise, the higher time frames, right? Those are things that really help you determine a clearer market structure. Okay. Now, okay, we got Burn saying there's no audio. I believe there's audio, right? Maybe you need to check your audio output that you're using. You're using the correct speaker. Okay. But yeah, if you're 20 minutes in and you realize that I'm not talking, that's something that you need to worry about. Now, all right, Fibonacci retracements. Okay, so what you will notice about Fibonacci retracements, right? There are the retracements that exist from 0 to 100%, right? These are the ones in the middle I talked to you about. There are the retracements that go beyond 100%. These are those over here. And there are the retracements that go negative, right? To negative 27 and negative 61.8. So how do these retracements work, right? Let me share it with you. Let me see if I can erase my drawings, right? And okay, let me just see. Okay, so Rich is saying it's a clear market structure is very is very subjective and it's a very vague concept. So I fully understand what you mean, right? Um, if if you want to put a defining term to clear market structure, right? What I will be it let's try to solve this, right? If in order to find clear market structure, right, what you want to do when drawing a Fibonacci retracement, one of the so-called guiding principles that you want to use is that yes, your retracement should follow price, should follow the trend line very well. The better you can follow the trend line, the better it will perform. Okay, so how do you know that it is a clear market structure, right? It doesn't matter if it's choppy or not. What matters is that you're able to draw a Fibonacci retracement accurately. Okay, Fibonacci retracement actually draws its theory from chaos theory. Okay, and that's where Elliott Wave comes from. A little bit of Fibonacci harmonics come from. It's chaos theory, right? There is the beauty in chaos, right? So what you have to do now is to look at the chaotic state of the markets of going up and down, and the concept of Fibonacci and chaos theory. That is where it brings meaning to it, right? And it can only bring meaning if you use it correctly. So don't worry whether you're looking at any market and like, is this choppy? Is this not choppy? Right? Is this ranging? Is this trending? You know, you do not know what to make of this market. All you need to do, right, if you're talking about clear market structure, is that when you're going to draw your Fibonacci retracement, when you start here and you end here, make sure that price follows your trend line very well. The clearer it follows, the better it'll perform. Okay? The clearer it follows, the better it'll perform. That's all you need to know. Okay, so let that be one of your guiding principles, Rich, when it comes to drawing Fibonacci retracements. All right, now back to my topic. When drawing Fibonacci retracements, you will notice that there's a portion in the middle that is 0 to 100. Those that are beyond 100 and those that are below are negative, right? So they're in the negative region. How does this work? Okay, let me see if I can highlight this to you guys. All right, and I'm going to use a highlighter instead. All right, so this is our starting point over here. Remember I said this is our starting point, and this is our ending point, right? So we drew a Fibonacci retracement this way. Okay, this way. What exactly is a Fibonacci retracement? Okay, assuming from my starting point over here, to my ending point over here, right? Assume that this is 100 pips. Okay, I'm just going to change my, I can't change the color of my highlighter, but yeah, assuming this is 100 pips. Okay, from my starting point all the way to my ending point, right? Let's just assume this is 100 pips. Okay, and what does a 50% retracement mean, right? A 50% retracement mean, right, over here, it means that price would have, from the ending point, it would have climbed all the way up to 50%. That means price would have moved up 50 pips. Fibonacci retracements is basically like dividing, right? What is 23.6? This is 23.6 pips, assuming this, your starting to your ending point is 100 pips, right? 50% is your midway point. 61.8 is, price have moved 61.8% of it. And yeah, so that is essentially what Fibonacci retracement is about, right? And once it goes beyond, it reached 71, 78%, it reached 88, and once it reached 100%, what does it mean? It means that your starting point to your ending point, price basically did what, a V shape, right? It come all the way down and it come all the way up. So it retraced a full 100%. So that is what it means when it retraces a full 100%. Then that helps you understand what it means when it retraces 127%. That means it goes even beyond the 100% and it goes all the way up to 127%. So this is where it gets a little bit crazy, right? That means you need to look at price that, okay, I can not only retrace all the way, to my 23, 38, 50, 61.8, 78, 88, 100%, but I can retrace beyond that, right? I can retrace beyond that and reach the 127%. Okay, so that is the concept of Fibonacci retracements that are beyond 100%. All right, what you usually have to look out for is a very clear V structure, right? And you look for a very clear V structure for this to be effective. Okay, what we cannot use, right, is something like let me see if I can find an example. Once again, what we cannot use is maybe an example like here, right? This is not a very clear V structure, right? This is not a very clear V structure because of the big distance over here, right? So if you're drawing a Fibonacci retracement, you start here and you end over here. Once again, right? Like what I mentioned to you, Rich, previously, it's all about having a clear market structure. When it comes to Fibonacci, right? The clearer, the clearer it is, the clearer price is to your trend line, the better it will perform. In this case, it's not very clear, right? In this case, it doesn't follow it very clearly. Hence, the effectiveness of the Fibonacci, right, will not be as effective when you're trying to project something in this direction, right? You're trying to project it in this direction. It's not going to perform very well. It's not going to perform very well for all this Fibonacci retracement. It's not going to perform well for anything, right? The clearer the structure is, the better it will be, right? In some cases, you feel like, okay, it looks effective, but that doesn't mean anything, right? The market, in the way it moves, right, you need to just stick to your guns, stick to your principles, and use it properly. Okay, now let's see, what about the concept of negative Fibonacci retracement? What does it mean? Okay, for negative Fibonacci retracement to work, right, your Fibonacci retracement should traditionally retrace anywhere to between 38 to 88%. Okay, let me repeat that again. For this part here to work, let me see if I can use a pen. For this part here to work, your Fibonacci retracement that you draw after you draw a starting point and your ending point, right? Your Fibonacci retracement needs to retrace at least up to 38%, right? Even if it retraces to 23%, it will not work, right? It will unlikely work rather, because the market, if you're talking about a 23% retracement, the market is kind of just going down, right? Market is just going down. A 23% retracement is not a big level. It's not too big a retracement, right? There are other reasons to use it in Elliott Wave theory, but if you're talking about like projecting further down to a negative 27 or negative 61.8, you need your Fibonacci retracement to at least go up to 38, 50, 61, 88, or 88, right? I will not go all the way to 100%, all the way here, and then it projects downwards. That is how Fibonacci and a negative Fibonacci retracement works, right? So let me show it to you in an example, right? Let me show it to you in example. So in this case, sorry, yeah, in this case, I'm not sure what we can use. Okay, one example. Let me see if this works. Yep. Okay, so let's see if I can do a bar replay feature, and I do it until here. Yep. Okay, so in this example, we see, right, price, this is our starting point, and this is our ending point, right? It's a decent movement all the way down. Price retraces up to 50%, right? Price retraces up to 50%, right? And from there, it starts to reverse, right? It starts to reverse. Okay, so because it has a reverse up to anywhere within 38 to 88%, right? I can do this thing called a negative Fibonacci retracement, right? That means it's kind of like another way of Fibonacci extension, but slightly different, right? So I get a project that price might come down to here, and if price comes down to here, what is it likely to do? It comes down, it bounces up, right? That's called a contrarian style of trading, and this is the technique which I will be teaching you guys, right? So so I know it has a benefit of hindsight, but we can see price, it comes down and then it bounces up. Okay, it bounces up a bit and then it continues going down, right? My style of trading, it's very much in scalping, so I only need to play this bounce over here. Many of you guys seen what I post on XC Traders Facebook, trading circle, right? I like to play the scalping trades, right? So I only like to go in, and when price bounce, that's all I'm trading, right? I don't need to trade a trade that go back to 300 pips, goes all the way to the moon, right? Later I expand a little bit more on that, but what I want to share with you is that that is how you use a negative 27 retracement, right? You need price to bounce up to at least anywhere within the 38 to 88% range, right? And once it bounces from there, right, that is where you can start projecting downwards, right? And then if it reaches any of these levels, that's where it can bounce nicely. Importantly, very, very importantly, is that you also need a very nice price structure for this to happen. Meaning, all right, I'm just going to erase all this here. What I mean, you need a nice price structure, right? How a negative 27% retracement works very well is that when price comes down, it goes up. You're looking for a clear movement down. You're looking for a clear movement down. You're not looking for a movement like this. You're not looking for this kind of movement. It won't work very well because this movement has its own chaos theory. This movement has its own chaos. This movement has its own. This movement has its own. Right. So Fibonacci retracements and extensions, they work very well when you're using the most recent market structure. Right. You're not looking for something that if the moment this happens, right, my retracement down here becomes ineffective because the market is not moving in like clear structures, zigzags, right? I always talk about zigzags. They work the best. They work the best when it comes to Fibonacci extensions. They work the best when it comes to retracements. They work the best when it comes to Elliott Wave. They work the best when it comes to harmonics, right? So always look for clear market structure in the form of price being very close to your trend lines, price being very close to the zigzags. Okay, now now we got a question from Hyten, right? What's the name of the YouTube channel to watch this webinar? I believe at the end of the entire session, at the end of all our of this initial training session of Fibonacci that's held by XC Trader, it will be on XC Trader's YouTube page. So yeah, but it only happens at the end. So so you know hang around and learn. Right, hang around and learn, right, instead of waiting until maybe I don't know mid-August or something before you get to see the sessions, right? And anyway, without digressing too much again, right, that is the concept of negative Fibonacci, right? Let me see, a negative Fibonacci retracement. Okay. Yeah, okay, yeah, that's the concept of negative Fibonacci retracements, right? They tend to be pretty effective. I like them myself, right? And let's see if I can use another example to show you. There we go, right? So this is how you remember earlier when I was sharing with you how a positive Fibonacci retracement works. You basically go down and then you do a V-shaped recovery upwards, right? This is an example of how that works, right? You go down here and you do a V-shaped recovery upwards. Okay, sorry, the V shape is even stronger, right? You do a V shape recovery upwards. The market structure is the market structure is very clear, right? So you can see it goes down, it goes up. It reached the 127, it didn't work out, and it reached the 161.8 here, where it has slowed down. Okay, now that is the concept of what I call, yeah, it's above the retracement is above 100%. All right, this retracement is above 100%. Now, what do I mean by Fibonacci confluence now? Right, what do I mean by Fibonacci confluence? Okay, let's see if I can let me see if I can pull up some of the these things over here. Okay, yeah, our next slide will share with us a little bit. Nope, actually, yeah, the next slide actually shows you, right? How, you know, how price, let's see, comes down to here, price bounce up. Oh yeah, this is an example of the negative Fibonacci retracement I was talking to you about, right? So so let me just draw it out. Same thing, you know, very clear market structure. Price comes down here, price bounces up to 61.8, and then, right, we project that if price comes down to a negative 27 level, there is a chance that you come down here and then bounce up. So our strategy is not to play the move down, right? Our strategy is to play this little bounce up here. Okay, that is the trading strategy which I'll be teaching you guys, right? There'll be a trading strategy which I'll be teaching you guys, and you can see in this example, right, exactly how price went down, it came up, and it went down, it touched the negative 27% over here, and then it bounced up, right? So what it likes to do usually, this is a pro tip, is that when it does a bounce up, it tends to like to go back to the 0% here, where usually from a structural point of view, right, there will be a pullback resistance. Like if you guys attended my previous webinars, you know what's a pullback resistance, right? So yeah, that is how pullback resistance and overlap resistance kind of work. Okay, so that is one of the ways that you can use the negative Fibonacci retracement. Okay, and I do want to wow, time is really flying by, man. I do want to touch a little bit on finding Fibonacci confluence. Okay, guys. Just thinking if okay, never mind. I will not touch on exactly how to draw Fibonacci. Instead, I will share with you the juicy stuff on finding Fibonacci confluence. This is finding Fibonacci confluence using just Fibonacci retracements alone. Okay. Now, this is your starting point over here, and this is your ending point over here. Okay. Starting point and ending point, a very clear market structure that we're looking at, right? We find a 50% retracement. Another starting point, ending point, we find a 241% retracement. Another starting point, another ending point, you find a 127 retracement, right? Because 1, 2, 3, all of them are lining up nicely together, we expect that if price actually comes down to this level, right, we can expect the bounce up, right? We can expect a pretty nice bounce up. How far the bounce is gonna go, it doesn't really matter, right? Because our style of trading, this specific strategy which I'm using, doesn't really try to play the big major economic so-called news events, 100 pips, 200 pips in one direction. We're just trying to play that little reaction that happens. Okay. Now what happens from here, right? Sorry, I need to erase this. You can see price really comes down. It touches the Fibonacci confluence area, and then it bounces up from there. Okay, that is the concept of using Fibonacci confluence. Don't just use one. I wouldn't just use 150% to trade by itself. Nor would I use 241 or 127% to trade by itself. But when combined together, right? You know what Captain Planet would say. You know, with our powers combined, right? It becomes better. I'm not sure how many of you guys know what Captain Planet is, right? I don't think I'm that old, right? But yeah, you know that it's all about combining the powers, right? Combining multiple levels together, right? Having a strong area of confluence, right? And then taking a trade from there. Personally, what I like is that if you combine both the higher, longer time frames and the shorter time frames, right, to find that specific area of confluence. Okay, I do want to touch on the topic now. I do want to touch on the topic where the question is, this trading strategy, Desmond, which you're showing me, right? This trading strategy, how many pips of stop loss and how many pips of take profit do you target? I can feel my sore throat coming back. I'm talking so much, right? Okay, we got a quick question from Tafatsua. Could you also do a webinar on Elliott Wave? Well, I believe that Elliott Wave is, well, Elliott Wave is not one of the topics that we'll be covering. But yeah, you know, you can request that, and I'm pretty sure XC Trader will be more than glad, you know, for us to accommodate you and create that webinar on Elliott Wave, right? But before you can even understand the concept of Elliott Wave, you need to be a master of Fibonacci retracements and extensions. Okay, so yeah, retracements, extensions, correlations, those are a few main things that you need to look at before you even grasp the concept of Elliott Wave. Okay, now back to this, right? Now this is a quiz time for you guys. Okay, quiz time. I have this trading strategy here, right? That has a 50 pip stop loss and a 90 pips of take profit. Okay, 50 pips stop loss, 90 pips take profit. I have another strategy, which is a 20 pip stop loss and 36 pip take profit, right? This is number one. This is the first one I'm showing you. This is the second one I'm showing you. Okay, which one, number one or number two, will make me more money? All right, guys, please answer. Yeah, please participate so I know that. So I know. Yeah, I can see what you guys are answering. Okay. Okay, we're getting a lot of we're getting a lot of questions actually. No, not questions. We're getting a lot of answers, right? We got some people saying one, some people saying number two, right? Yeah, actually everyone has an answer. I see one very nice answer here, right? That comes from Mark. Both marks, right? We got two marks that are saying that it is the same. Now, take out your calculators and calculate this with me, right? So the first one is 90. Oops. Take out your calculators with me, right? I know a few of you guys are saying it depends on the percentage of risk, but assuming you risk the exact same amount, right? Take out your calculators. The first one was 90 divided by 50, right? The second one is 36 pips of profit divided by 20 pips of stop loss. What is your answer, right? Just take out your calculators and calculate. Can you tell me what is your answer? If you're on Google, you can just type out. Okay, guys, what is the answer to this? Christian, I see that you're rounding up. You don't need to round up, right? Okay. What you will realize is the answer is 1.8. It is the same. It is the same between the first and second. So what does that mean? It means that my take profit, 20 times 1.8 is 36. 50 times 1.8 is 90, right? They have the same risk to reward. So one goes for 36 pip, one goes for 90 pips of profit, but they make the same money because it's not only about how much you make, but it's also about how much you risk, right? So seeing the answers here, right, guys, seeing the answers here, what I really want to teach you guys is that don't be tricked by the gurus out there who say, I made 100 pips of profit today, I made 200 pips of profit, right? Profit means nothing if you do not know what was his risk that he was risking on the trade. I made 100 pips of profit, but my stop loss was 1,000 pips away. You never hear anyone say that, right? That is what scam artists do. That's what people who are trying to trick you to do. They show, I made 100 pips of, it's a 100 pip trade, but they don't show you how much they were risking, right? If he was risking 1,000 pips and he made 100 pips, that's terrible. That's absolutely terrible, right? That means his risk to reward is 0.1, right? It's essentially 0.1, right? One losing trade can wipe out 10 of his winning trades, right? So I need you guys to grasp the concept here that when it comes to trades, don't think about the take profit, how many pips of profit you're going to make, right? Instead, look at it both sides. How many pips of profit you're going to make, and in order to make that many pips of profit, how much are you risking? The less you risk, the better, right? In this case, risking 20 pips, right? gives me 36 pips of profit, right? My risk to reward is 1:8. If I risk 10 pips, right? If my entry is so accurate, right, that I'm only I'm confident enough to risk 10 pips instead, my risk to reward becomes 36 divided by 10. It becomes 3.6, right? And if I am super duper accurate and my stop loss is only 5 pips, and this is where scalping comes in, right? Suddenly my risk to reward is 7.2, right? And this is really, these are really good numbers, right? Even 1.8 is a good number, right? So you got to wrap your head around the concept that it's not only how much you make, how many pips you make, but it's how much you risk. And it's not only about the big numbers that you're looking for. I can make 5 pips a day and I'm happy, right? I can make 10 pips a day, right? If my trade, and many of you guys in the trading circle, you see the way I trade, right? Most of the time I'm targeting 10 pips, right? And I'm glad I'm having this webinar with you guys now to let you know that just because I target 10 pips doesn't mean I'm trash, okay? If I target 10 pips profit, if my TP is 10 pips and my stop loss is 5 pips, right? My risk to reward is 2. And most of the time you see that my stop loss is 5 pips to 10 pips, right? I keep a very tight stop loss, a very tight take profit. And that is the concept of scalping. When it comes to scalping, it's not about, hitting, scalping or day trading or swing trading. You're looking for 100 pips of profit. But at the same time, your stop loss could also be 100 pips, right? You're playing a very wide range, right? And because of that, you need a very wide stop loss, and you're targeting a bigger take profit, right? For scalping, that's where the accuracy comes in, right? I'm only targeting 10 pips, but at the same time, I'm only risking a few pips. Why do I like scalping? It is because it allows me to stay away from news events, what I call known unknowns, right? And I shared with you guys before. A news event is called a known unknown, right? If I'm going to spell it out for you guys, it's a KNOWN, is a known unknown, right? I know that is coming. I know that the non-farm payroll is going to come on Friday, the first Friday, but it's an unknown outcome. How much is it going to move the markets in one direction or the other? I have no idea, right? It's a known unknown. Okay. Now, when it comes to scalping, I get in and out of the market fast, right? So imagine, I'm just gonna erase all drawings over here. Imagine this is a day, right? This is your start of the day, and this is the end of the day. Okay, in between the days, there are many news events, right? There's a news event here, news event, depending on all the different times. There's so many news events, right? Now, there's so many news events. Okay, what is likely to happen when you trade? One might push the market up, one might push the market down, one might push the market down, one might push the market up, right? There are many ways that the many ways that this can affect the market is that you can push it up. Sometimes it can be pushed up, sometimes it can be pushed down. Okay, now when you hold a trade for the entire day, right, you are leaving your trade exposed to many of these known unknowns, where price can go up and price can go down. Okay, but when it comes to scalping, right, we usually look to stay away from these big news events, right? We play the moves in between, right? I can hold a trade for maybe just 1 or 2 hours, get in and out fast, and this is my trade, right? If I got another news event here, I get in and out fast over here, right? Scalping, because of how quick you get in and how quick you get out, it allows you play this it allows you to exist and trade in an environment where there's no big news events that occur that can push push the trade very strongly in one direction or the other, right? Okay, now moving on, right? Moving on from here. Let me just erase it. That is the reason why I prefer scalping. Okay, that's the reason why I prefer scalping. Let me see what I'm going. The things about so it's not only about the number of pips you made, but it's also the risk to reward of your trade. Okay, it's a risk to reward of your trade. So I got a question from from Henry, right? How many pairs do you look at, right? I can show you my what I usually look at, my trading setup, right? Now this is the trading my trading setup is usually like this. Okay, I would go into the 4-hour charts, right? I'll kind of look for clear market structures across over here. Let me see if I can show you. This is one tab. This is another tab that I have, right? I'm not just creating this. I'm just dragging it from one computer screen to another computer screen, right? I'm just showing you all the different setups that I have, right? I'm monitoring literally almost every single major and minor currency pair, right? And I'm just seeing how it moves. I'm looking at Aussie yen over here. I'm seeing pound yen. That's a very nice market structure. Aussie yen looks like there might be a very nice market structure here, right? And then I pull this out, right? Because I see there's a nice market structure, and I start doing my Fibonacci. Okay, I look at the zigzags, right? The first I do a Fibonacci retracement from here to here, right? I look at the levels. I do a Fibonacci extension from here down to here and up to here. Is there any level where they all line up very nicely, right? I can look at the levels, and I can honestly tell you, no, there isn't a level that lines up very nicely for this yet, right? And because of that, I will close it off. I saw pound yen over here. It looks quite nice. I click on this, and I take a look at the market, right? So one thing I'll do is I'll do a Fibonacci extension from here down to here up to here. I noticed the 78.6 extension over here, which I like, right? But at the same time, it's only a 78.6 extension. I can't find any other big level around there, right? There is the possibility of drawing a Fibonacci retracement from here all the way up to here, right? And suddenly what I notice is that, okay, this follows the market decently. It's not the best kind of market structure, but it still follows it, especially for a long-term kind of Fibonacci retracement, right? It follows the market pretty decently, right? I noticed that there's a 50% retracement over here that lines up with my 76.4 retracement. At the same time, it is also below a big swing low. So what tends to happen, this is what I call the market, the stop hunt setup. All right, this is what I call a stop hunt setup. So there's a very high probability that this is going to be a big area of interest. Price is going to fight over here. It's going to spike down to this Fibonacci extension level, and then it's going to bounce up. How high it's going to bounce, I don't honestly care, right? What I'm trying to play is I usually play to the most recent 23%, right? The 23% is the most recent level I play to. So if price comes down here and it bounces up to here, I will get out at 23%, right? So that is all I'm going for. I'm just going for a small little movement here. I'm not trying to play the move all the way up to here for a V-shaped reversal. I'm just looking to play this movement here because a very nice 78.6 retracement, a very nice 50% retracement, a very nice swing low support area is all lining up here. There's a higher probability that price might bounce up here versus breaking down straight away. My stop loss, I will put it below the next big level. So if this is an 88% retracement, my stop loss would be slightly below that level. Okay, I'm just looking to get in and out fast, right? And I will only go for levels which are untested. What do I mean by untested is that there is, price never came down to this level before, right? Price never came down to this level before over here, right? Because we're always trying to be one step ahead of the market. So if price came down to a level, to me, it becomes a game of support and resistance, right? But the beauty of chaos theory, the beauty of Fibonacci retracements and extensions, Elliott wave structures and harmonics is that you can predict into the future how price is going to react off certain levels, right? So if you follow me on the trading circle on XC Trader, right, you notice some of the trading setups we do. We always forecast into the future, and most of our trades are pending orders. They're never market orders. They're forecast into the future where a reversal might happen. Okay. Now, so one of the setups I was actually looking at earlier today was CAD yen, I believe. So this setup on CAD yen, which I particularly like, right? So how would go for a setup here, right? I'll go for I'll look for the zigzag kind of formation. I notice a 78.6 retracement over here, right? It lines up very nicely with my swing high resistance over here. I'm not sure if you can see it, but yeah, there's a nice, there's a nice swing high resistance over there. There's a nice 78.6 extension over there. There's a nice 161.8 retracement over there. Okay, so how many levels are over here? Minimally, I look for 3 levels. One nice extension, one nice swing high resistance, one nice 161.8 retracement. As long as there are 3 levels that add up at a certain level, right, I would look to at least play a small move from there, right? In my trading strategy, I'll be looking to take a position here. My take profit, like I mentioned, is 23%, right? So we can see that price actually touched this level and it fluctuated down to the 23% area, right? So I don't look to play a big move down. I only look to play the reactions, right? Strictly speaking, I call this the reaction trade, where you're only looking to play the reaction. You're not looking to play the big move up like a position trade where you hold it for a long time. You're only looking to play the quick reaction. Okay, so yeah, in this case, a quick reaction off there and it drops down. Let me see if I can find any other levels for you guys that we could possibly trade from. Right, that actually falls more under a live trading session, which we'll probably have in the future. But I might as well just take these last few minutes I have with you to show you how I would do my own trading strategy. Right, so I'll take this big move all the way down from here to here. 78% retracement, lining up very nicely with 88. I'm starting to notice that. 88% retracement lining up pretty nicely with 100%. I do a retracement from here down to here. Right, do I see anything? Nope, nothing worth looking at. I do my little zigzag retracement. Do I see anything? Nah, not really anything. And my last zigzag retracement from here to here. Okay, not the best retracement again, right? Not the best retracement, but 127% retracement lining up with 100%, lining up with 88%. This to me, assuming price continues up nicely towards here, this would be a level for me to play a quick reaction from. That's essentially how I trade every day, right? All I do is I just open up a chart, right? And I see, is there a clear market structure, right? And I look at this, is there a clear market structure? Not really, nothing nice, right? I click here, I load this, Kiwi dollar, is there a clear market structure? There is possibly something, right? So I do a Fibonacci extension here, right? I notice it's 100%. I do a nice Fibonacci retracement from here to here. Any of the levels line up nicely? Nope. I do that little negative retracement. Any of the levels line up nicely? Nope. Done. Move on to the next one. Right. This is essentially how I trade. Market structure. I'm looking at this. That looks like a nice Fibonacci extension up to here. Okay. At the same time, it looks, I can do that negative Fibonacci retracement. At the same time, I can do another Fibonacci retracement. Any of the levels lining up nicely? No. Okay, it's okay. Right, I will continue. Right, that is essentially how I trade. Right, yeah, that's essentially how I trade. Right, so it's a case of just looking at Fibonacci confluence levels, finding an area where everything lines up, and then I take a quick trade from there. Right, I'll play to the 23% retracement, and that's it. Right, I'm not looking to play it too far.